Hello investors, welcome to Wisdom Owl. Today we are going to talk about EPAM Systems, which is currently trading at $160. Just a few years back, the company was trading at its all-time high of $700. Going forward, the company can see strong earnings growth, and based on those earnings growth, it looks very undervalued right now. Let's see how undervalued it is. If you see this forward price to earnings plot of EPAM Systems, it's trading at 15, which is the lowest it has ever been in its history. Even during recession of COVID and the nearest correction of 2022, it was trading between 20 to 30 PE, forward PE. When you compare to its competitors and see where have they been trading in last 1 year, even in comparison to those, EPAM Systems has fallen a lot, is lower than them at 15 forward PE. The third aspect is to check if what has been happening in terms of price to revenue or price to sales ratio. The company is at its lowest even in terms of its price to revenue or price to sales ratio. Now the fair value for this company is around $200. And in this analysis, we'll understand now what EPAM System does. It provides digital platform engineering and software development to a lot of players in the industry. It has software and consulting expertise. So it's a digital transformation services company. If you want to go through into the details of the business and what are the investment opportunities and risk, you can look into app.wisdomowl.ai. But coming back to how $200 is a fair value for EPAM Systems. If we see what has happened in these last 5 years is a boom bust scenario. Earnings grew a lot during this COVID time, and then they have not recovered or have not grown after the burst of COVID. There are a lot of green and yellow signals which we can see in its top investment metrics. For instance, the green is that the free cash flow has been increasing consistently in last 5 years. Number 2 green is there is no debt on the company. Then third is it is showing consistently strong liquidity position. And as we discussed, the price to free cash flow or even price to earning ratio seems to be low, right? And another important point to note is that the revenue has been increasing consistently. It has more than doubled in last 5 years. But this revenue increase is not reflecting in the earnings. And that's happening if you look at the margins of the company. The margins of the company, though, have stabilized but are not to where they were the beginning. This is where the earnings are getting hurt. But going forward, if they improve as a business and if they can compound their earnings using their free cash flow and the revenue growth, they can become an earnings compounder. Now, going forward, even if they can compound their earnings at around 12%, which is completely plausible, the fair value for the company is $200. Now the question is, can they compound their earnings for 12% for next 10 years? And this is the estimate of how they can do this. They can use their operating leverage and their business's revenue is growing, so they can work on their operating margins, which can contribute to say 6%. Similarly, they are continuously buying back share, which can bring in more growth. There is a digital transformation demand in the industry, which can bring in more growth. Similarly, there are some risks involved, and if we compensate for those risks, this 12% doesn't seem to be a very high number. So buying this below $200 seems to be a good starting point. So this was the short analysis on EPAM Systems. If you liked it or if you want to read more on this company, you can log into app.wisdomowl.ai. And if you want such small analysis going forward, please subscribe to this channel, Wisdom Owl. Thank you.